It's been almost 2 weeks since the latest rate cut from the Bank of Canada back in July, and at this point we can sit down and try and assess the situation. Has anything improved in the real estate marketplace, or things have been deteriorating? Unfortunately, things have been spiraling out of control. The inventory is still soaring, and the buyer activity is close to zero. That's from the latest report from RBC, and this is the main topic of the conversation in this video. Canada's housing markets look for deeper rate cuts to ramp up activity. That's coming from RBC. The Bank of Canada's interest rate cuts in June and July likely marked the turning point for struggling housing markets across the country. But so far, the impact has been mixed. Well, if you look across the country, yes, the impact may have been mixed because there are some pockets and some regions where there's been uptick in activity. But here in Toronto and the GTA, and this is the primary concern of the videos on this channel, the situation has been deteriorating. The inventory has been increasing and buyer activity has been close to zero, particularly within the condo segment of the market. We effectively steamrolled over this announcement from last week for the Bank of Canada. It's actually been 2 weeks. I apologize. 2 weeks ago. Without any noticeable improvements, situation has been deteriorating, and it's absolutely clear for anybody who's in the field and working in real estate in the GTA. After a small uptick between May and June, home resales fell again in some markets, including Vancouver, Calgary, and Toronto in July, according to early reports from local real estate boards. However, activity picked up slightly in Edmonton and Montreal. It will take deeper rate cuts to meaningfully reduce ownership costs and stimulate home buyer demand more broadly. Absolutely, we need to be somewhere close to 3% for the overnight rate for things change. Thank God the 5-year government bonds have been trending down, or the yields for those bonds have been trending down, and that has direct impact on people that will carry fixed mortgages. 90% of the people that carry a mortgage carry fixed rate mortgages. The remaining 10% are on a variable rate. We had a few conversations about the possibility of an emergency rate cut south of the border. It's still unclear whether the Fed will seriously be considering that. And if that's in the cards for the Americans, then the Bank of Canada will be looking very closely at what's happening there. And we might have an emergency rate cut here. Who knows? We'll see what's going to happen. If that occurs, then yes, the market most likely will quicken and buyers will start getting interested in getting active. Look, the reality is we are at 4.5% for the overnight rate right now, with prices now 3 times higher than what they were back in 2007, where the interest rates were very close to what we have at this point in 2024. Supply, on the other hand, continues to grow. In some cases, such as Toronto, it reflects the completion of many newly built units, mainly condos. And I have to say, in my previous video, I said that about 60,000 condos are scheduled for completion between now and the end of 2025. I may have overstated the issue a bit. There's about 25,000 units that are scheduled for completion in Toronto for 24, and for 25, we are talking about projections. So we're not sure what's going to happen. Maybe there'll be fewer buildings that will be completed then, but still we're talking about tens of thousands of units being completed in the next year and a half. And what happens is that investors, and they constitute more than 50% of the people that purchase those units, are looking to offload, not close, do something with those units so they don't have to carry the liability. In other cases, it could be sellers getting or betting rather lower rates will spur buyer interest and improve sale outcomes. In some, it may be a sign of homeowner distress arising from high rates. Absolutely. People are overloaded with debt, and homeowners and investors that have put their trust into the economy chugging along in 2024 are not getting any of those promises fulfilled. Okay, so let's look at the volume of resales versus new listings. We're not talking about new completions, we're talking about resales here. Home resales at 3.3%, new listings are at 18.5% for the Toronto area. This parity is practically 5-fold. 6-fold, actually, in this case. Toronto area slump ongoing while inventories mount. Yes, the issue is going to be further exacerbated come September and October and November. Traditionally strong fall market is not going to be very strong this year. At least that's what it appears to be, or that's the outlook that I would say we would have looking at it from the month of August. A lot of sellers have decided to hold off listing their properties until September. hoping that the interest rates will be further decreased during the announcement in early September. And then after Labor Day, the market just seasonally adjusts and starts chugging along at a much faster rate. The market can best be described as lethargic this summer. A modest resales advance in June was mostly reversed by a 0.7% dip in July, leaving activity little changed from where it was in the spring. Buyers are clearly looking for larger rate cuts amidst strained affordability. The situation is livelier on the supply side, though inventories are accumulating rapidly as soft demand comes well short of absorbing the surge of properties up for sale. This is especially true for condo apartments, where a wave of new unit completions this year boosted active listings by 64% from a year ago, a staggering change. Detached home listings are up less, although by a still considerable 48%. Home prices have stayed largely flat overall in the past 4 months. We're definitely in the buyer's market territory, not only based on the numbers that we're seeing and the numbers that we've discussed on this channel in all the previous videos, but just from the experience of being in the field and looking at the behavior of the listing agents. They're very eager to accommodate, they're very eager to sell, they have tough conversations with their clients about the prices and conditions in the marketplace, fully anticipating that the market is going to get worse in the fall. The activity might increase, but so far the outlook is pretty much negative across the board. The aggregate MLS home price index benchmark was 1.09 million in July, virtually unchanged from April, but it's down 5% from a year ago, reflecting last fall's mild correction. Condo prices accounted for most of the annual decline, minus 5.1%, with detached home prices at minus 4.3%, not far behind. We expect mounting condo inventories will put downward pressure on prices in the near term. Recovering demand later this year and into 2025 should contain that soft patch. So we're finishing off this paragraph on a positive note, although whenever you're reading articles from economists, there's always this future target of things are going to get better sometime next year. 6 months to a year, things are going to improve. There's going to be a soft patch, but there is some positivity for all of us to look forward to. And this is a chart of what's been happening with Toronto area home resales. And look, we're not too far off from the levels of 2020, where the market dipped in the middle of the COVID pandemic. There, the dip was super severe. Home resales were at 27,216 units. And right now, we're at 64,812 units, with the market again trending down. I wanted to keep this video relatively short, and the main focus of the conversation is that the inventory levels continue to soar, whereas the buyer activity is extremely low. Most likely, the same pattern will continue into the fall. One thing that's kind of concerning right now is that there are talks about the Bank of Canada assembling a panel of friendly experts who are going to be looking at reasons for inflation during the pandemic years, when the Bank of Canada was printing money or engaged in the quantitative easing program. And that panel most likely will come to the conclusion that it had nothing to do with the money printing issue by the BOC, but rather had everything to do with the supply side of the equation. There were problems with the supply chains, and therefore the inflation soared out of control. If that's going to be the conclusion, which is very likely, then it's quite possible that the Bank of Canada will engage in the same money printing activities between now and the end of the year, and possibly into 2025. Hard to tell at this point, but we need to be on the lookout. As always on this channel, we're going to be covering things from two separate angles. On the one hand, we're going to be looking at the numbers and discussing what's happening there from the statistical perspective, and the other point of view that we're going to take is experiential. What's happening with us being real estate agents and talking to buyers and sellers every day and seeing the market from within. So that's about it for this video, guys. If you like the content, consider giving it a thumbs up and subscribing to the channel. And I'm looking forward to seeing you again next week with more updates and more news. And I'm really hopeful that the news are going to be more positive. That's about it, and I'm out.